The starting place, the foundation is fixed income. They're bonds. Not very sexy, not very interesting. No one's ever going to give you a compliment about your home's foundation. I don't think anyone really will look into the crawl space and be like, dang man, that's a nice one. But at the end of the day, it is what's responsible for keeping your home upright.
Hey everyone, welcome back to another episode of AWM Insights. It's your host, Justin Dyer, Chief Investment Officer here at AWM Capital, and joined as always by Mena, Hanna, our portfolio manager here at AWM. And today we're gonna actually talk kind of an extension of an internal meeting that we gave to the team yesterday. Around just like the fundamentals, going back to the basics. It's always great to revisit those fundamentals, whether you're investing or, playing baseball, football, choose your sport, choose your profession. It's always a very, very healthy exercise to challenge yourself on the fundamentals. And hey, do we have the basics dialed in here? Really without giving too much of the conversation away, the fundamentals of building a best-in-class investment portfolio, institutional grade investment portfolio really starts with the foundation, right? And we'll probably talk a lot about the home analogy, home building analogy. You can't build 100-year home, 100-year family without the proper foundation in place. And what that then ends up looking like from an investment perspective is investing in bonds and fixed income, as we call it. There is such a close relationship between fixed income, interest rates throughout the economy, and inflation. And interest rates and inflation are both very, very important to the Federal Reserve. I'm sure you all know that name. And this is also kind of teasing out a conversation or an interview we're going to have over the next couple of weeks with someone who knows that whole world exceptionally well. And so really kind of laying some groundwork today, but also going to the fundamentals in anticipation of that conversation down the road. So we're going to get into that today. Mena, as we always do, I guess, let's start with the basics and build on that conversation. So building a best-in-class institutional portfolio. Again, I referenced building the house analogy, building that 100-year home, that 100-year portfolio. How do we do that in a summary type term or terminology?
And I want to sort of stress the 100-year home piece, because if you're building a home, you ideally want that to be there for, if this is your family home forever, if this is a multi-generational home, you want it to be there still, and you want it to be upright in 100 years or in however long it actually takes. We're sort of very fortunate to live in Southern California, but there's downsides like earthquakes. If you are going to build a home here, you're going to build it up to spec and up to code, especially from a foundation standpoint, so it can weather the 7.5 earthquake that is inevitably going to hit California. Now, we haven't had an earthquake that's that big. It's kind of like financial markets, actually. Like the last real sell-off that we've had in equity markets that's been prolonged has been 2008. The last, call it, substantial earthquake that we had here was 2019. We are in a period of time where we're spoiled, and a lot of people in these periods of time get complacent and don't focus on the fundamentals, on the foundation of the system, which is, I would argue, the most important thing if you want to make sure that your house is, upright in 100 years. So the starting place, the foundation, as you referenced, is fixed income. They're bonds. Not very sexy, not very interesting. No one's ever going to give you a compliment about your home's foundation. I don't think anyone really will look into the crawl space and be like, dang man, that's a nice one. But at the end of the day, it is what's responsible for keeping your home upright. It's responsible for also, laying out the framework of all of the other interesting things that you're going to have in your home, your kids' bedrooms, so that they don't have to, sleep in your room and you don't have to hear them. The pool house, we always make that analogy, the garage for me. So all of these things end up kind of being meaningful, but they start and they fundamentally need to be established by a foundation that's not all that interesting.
Yeah, I mean, I would pull on that analogy even a little bit further as well, right? Like not only is the foundation exceptionally important for all the reasons you're talking about, but figuring out the right foundation you want ahead of time is arguably just as important. And maybe those two things go hand in hand. But the analogy here is like you build I don't know, a foundation for a 3-room house, and then 5 years later you're like, oh, I actually need a second story. Well, guess what? If you didn't build the foundation to deal with the second story, you're potentially in a pretty bad situation, or you have to start all over again or something like that, right? Like that is also really, really important in this conversation. And the true analogy here is or the true reality, that's the analogy, but the true reality is we need as much precision as we possibly can around priorities. What are important to our clients so we can build that proper foundation. Yeah, we know that life is not 100% predictable ahead of time, but let's, err on the side of caution, if you will, or let's try to capture as much hypothetical or potential as possible so we can start that foundation, especially if someone is early in their investing career or playing career or professional career for that matter. If we can start with as much precision and erring on the side of conservativeness, then that foundation is very much set up for that 100-year journey. The portfolio is set up for that 100-year journey through the protection and solid construction of a bond portfolio.
Yeah, the cool thing too there, and you sort of highlighted it, was if you set up the foundation in the right way, you're actually setting your odds up of not just overall success, but you're giving yourself the opportunity to pivot even when there is potentially a disaster, when things do go wrong. If you have a kid, when there's a natural disaster, people, your home hopefully was built in the right way, it's still upright. You don't have to be rebuilding, but if you have a kid, you need to add that extra bedroom while everyone else in the market is rebuilding and you weren't thoughtful about planning, you're going to have a terrible time trying to find, a contractor or someone that's willing to take on that project. Getting ahead of things, establishing the foundation in the right way, I would argue not only just protects you in the long run, but helps you with these kind of nimble decisions that sometimes just our clients have to make. A lot of our clients are just, honestly, on the younger side, there's just a lot to life that's happening. There's a lot of shifting that's happening. There's marriages all the time, kids being born. There is the desire, and I would argue the need to be nimble and to shift. Setting your foundation up in the right way, having the right site plans, having the right land, the basis for this 100-year family is amazing for you over the long run, over that 100-year time period, but also adds a lot of just convenience, and I would argue also ability to shift and pivot when necessary. So it's multifaceted in terms of the benefit that a well thought out foundation can add.
Cool. Well, I think we've used this housing analogy, home construction, home build analogy enough. Maybe we'll weave it in one or two more times. But let's take the conversation to, okay, we've talked about the foundation. We've talked about that being bonds, which again, bonds are loans to, in most cases in this point, in this conversation are loans to the federal government. So very, very safe loans that you get paid back at some point in time. Interest rates are a critical part of those loans, those bonds, right? You make an investment, buy a bond, you get an interest rate. Very closely related to that is inflation and the Federal Reserve. Let's talk about the inner workings of those, let's call it 3 components, 3 variables, however you want to define it, Mena.
Yeah, and they're all tied together. The analogy that I've sort of come up with is the Federal Reserve is in charge of the traffic and movement of money. So they have their target. They set a 2% inflation target long term, and they are in charge of making sure that money and sort of traffic, if you will, flows at that rate. Now, we live in LA. We have a ton of traffic. What the Federal Reserve can do during periods of time is open up new lanes in the freeway to make sure that, money is flowing through and inflation is around that 2% number, which you can effectively think about as like a 65 mile an hour speed limit. If there's too much traffic, if, the economy is not functioning appropriately, they're going to open up more lanes and help traffic flow ideally at the speed limit and get the economy moving back at the speed that it actually ideally should move. And that long term is at a 2% inflation rate. The other thing that they also try to fight is people that are going 100 miles an hour on the freeway. You can't open up 12 lanes in every which way, or else people are going to move too fast. In a period of time is sort of the 2 years after COVID. Inflation was at 9.1% year over year. It peaked at that number. That's sort of like if the average speed on the freeway is 120, totally dangerous. That destroys value, that destroys purchasing power for investors and for consumers. So what they do in a situation like that, they hike interest rates. They try to reduce the speed of the freeway. They close down some lanes. And that hopefully gets the market back down to a spot where traffic is still flowing, but it's flowing at the rate that they want it to flow. So the real lane opening, closing is the lever that they can pull on. They want to make sure that the economy is moving. There is the right amount of flow. There isn't a traffic jam, which would be essentially a recession or an economic slowdown. There isn't kind of the wild, wild west of the Nürburgring or I can't remember that road in Germany that has the Autobahn that has no speed limit. That's the opposite place. But so yeah, they are trying to find that sweet spot and manage inflation to be at the right level.
Yeah, that's super helpful. And so kind of bringing this together, right? We have the foundational aspects of the 100-year home, the 100-year family being the bonds in a portfolio, the fixed income part of the portfolio. The way we allocate those are generally speaking to U.S. government bonds, which are very, very closely tied to the variables and forces that you're talking about. When the Fed increases interest rates to try to slow things down, well, that impacts the bonds you are holding, and they're trying to make sure that there's a little bit of a return or yield, as we call it, over and above inflation. So we're at least keeping up on that. And then you're able to accomplish what is most important to you with those dollars, right? That is exactly what we're trying to do. Money is a tool to accomplish what's most important to you. We protect the most important things, certainly over the short term, with fixed income and bond type investments. Those investments are directly impacted or for the better and sometimes the worse in times of stress by what the Federal Reserve is doing. So really, really important. A lot of nuance to all this. Hopefully we didn't go too deep into the various aspects of Federal Reserve policy setting, inflation, interest rates, and fixed income. We really want to try to stay high level and pretty basic here and build on it and have someone who was really boots on the ground and understands the motivation behind the Federal Reserve coming on the podcast in the next couple of weeks. So we're really excited about that. We're going to do our best to prepare you listeners for that conversation. But also let us know any questions you may have, both with respect to this topic, this conversation, or otherwise. We'd love talking about it. Mena will give you the number to text.
626-862-0355.
Awesome. And until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.